Today, folks, let me help you appreciate the opportunity that stands before you. It's hard to grasp that basically since 1940, there's only been 32 times the S&P 500 has corrected by 10 to 20%. There has only been 4 times where it is corrected by 30 to 40% and 3 times where it has dropped more than 40%, meaning there is only a chance of maybe once or twice in your entire lifetime on this planet where you're likely to see the S&P 500 drop by that much. So we are truly in a place where there are discounts, and I want to talk about those stocks to buy today because the opportunities are literally shown to you. The market's screaming at you, look at the uncertainty. Without any of this clarity, the drama queen that is the S&P is going to majorly oversell stocks into the future without understanding where the future is going. Yet once we get certainty and clarity and we realize that these companies might not be as bad off as the market is telling you they are, they're going to over dramatize themselves back up. You don't want to be out of the market on those days where you get those major pops of clarity, right? So what's causing the uncertainty? Well, we know it is Donald Trump. It is a self-inflicted wound. And basically, as of today, Trump is saying there's no inflation. This guy's hilarious with these costs trending nicely downward, just what I predicted they would do. There can almost be no inflation, but there can be a slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates now. Europe has already lowered 7 times. Powell has always been too late, except when it comes to the election period when he lowered in order to help sleepy Joe Biden, later Kamala, get elected. How did that work out? What's hilarious is people are claiming that Trump is building up the narrative to use Jerome Powell, the head of the Federal Reserve, who I don't know whether he should cut rates or not. I'm not in his chair looking at the data, and he's claimed that he doesn't look at politics to make his decisions, but they're claiming that Donald Trump is, teeing up the idea that Jerome's going to be the scapegoat when Trump brings down the economy as we continue to deflate. But that shouldn't, stop you from buying stocks, because right now it is really getting dramatized as we're waiting for tariff deals with China and many other countries that have not come into play yet as other countries look to be making deals. We do not know what the long-term impact is, but I know for a fact it's not going to hinder all of these companies to the extent that they have already dropped. So let's talk about it, because the S&P right now is in the limelight of utter pain. I mean, the S&P 500 is now down 12% from the beginning of the year, from peak to trough. I don't know how, it's about 15-16%, but comparably, Canada is only down about 3.8%. The Shanghai composite here is actually green on the year. The Europe 600 companies are flat on the year, and basically every country is starting to perform exceptionally well as these countries start to pull money back out of US dollars, probably into their native currencies. The other big thing that I appreciate Jerome Powell waiting on is he realizes that tariffs are inflationary. You're going to charge a tax on anything coming into the country, and the currency, because of Trump, is starting to collapse. Not in a major way, but it is dropping. I mean, since the beginning of the year, it was sitting at about $1 or 108, and now it's trading, the DXY is at like 98. So you've seen a good, healthy 10%, 15% correction in the dollar as well. So that means you have tariff tax, and anything you're buying from China with US dollars is now a bit more expensive just from the dollar conversion. All of that is inherently inflationary. So just because oil and commodities are dropping, like Trump says, doesn't mean we're not headed back toward an inflationary cycle. Like I said, I'm not an economist. I don't have the data he has, but all of this is raising concern in the market. And like, Hudson Bay here going out of business, like the wife wants to walk in and take a look at those discounts. I walk into the S&P 500 and I say, hey, what's on the red tag sales today, baby? And the market tells you quite dramatically where the money is going. And it's not going into the Mag 7 anymore. And that's where the discounts are today. But we want to wean them out and look for the best discounts, right? Because I hear so many YouTubers saying, ooh, look at the stocks I bought that are performing better than the Mag 7. These are the best stocks to buy just because they're going up, which is absolutely moronic. You want to buy the stocks that are quality AAA rated companies that are going on discount. You don't want to go to where prices are going up. You ever walked in a store and said, oh, I'm going to go to the aisle where things are the most expensive? No. I'm going to go to where all those red tag deals are first, right? Let's see what's on sale, baby. So let's break it down with the biggest mega cap companies. First and foremost, Apple. Apple to me is not in a major discount territory. In fact, it is still a hyper expensive company. These companies will always deserve a premium because we're all using Apple products and will continue to probably for the remainder of our lives. But at a 30 times multiple for a company that doesn't grow and hasn't grown since basically, the beginning of 2022, I'm a little disappointed. And they have a lot of concerns with tariffs, which makes sense why the stock's dropping because, the iPhones are built internationally and they're never really going to be built, I think, to a major extent in the United States. And if we look at the earnings per share growth, there really isn't any. I mean, the stock has been relatively flat. So I'm not a big fan of looking at price ratios going up in a period where the company has virtually no real growth. Those are all metrics that don't really get me that excited. Now, a lot of people have been telling me Amazon is going on a major discount spree. And I've been thinking quite literally about this because Amazon doesn't really produce all of its profit or the vast majority of its profit from Amazon itself, like the shipping that it does for the resellers or the retailers that sell through Amazon. So all those retailers, or at least 60% of them, are buying product from China. They are going to feel quite an extent of pain, and Amazon has now dropped 30%. But if we take a look at those numbers, Amazon's done a great job with revenue growth. Double digits, company generating $600 billion can still grow at a 10% clip is mind-blowing to me. But if we look at the earnings per share growth, this is where people are saying it's at a discount because this company has been growing its earnings and being able to actualize some earnings by 50 to 100% quarter over quarter here. Like on an annual basis, this is incredible growth numbers, right? So people are saying that if you look at the current price ratios, if they can keep growing even for the quarters to come, at a 30 PE, this thing is looking damn cheap. The problem is we don't really know how much pain is going to be caused by tariffs, and we have to see if they can continue to actualize earnings growth, probably on the back of their cloud computing and their data centers. It'll be neat to see how all of this pans out. But yeah, Amazon actually might not be that bad of a stock here, but we need that clarity. We're heading into an earnings season, and this is where I think we'll kind of figure out what companies are resilient and what ones aren't. Because regardless of politics, these are great companies. It doesn't matter where they would be in the world. I would still want to buy them regardless of those politics. So let's talk about Microsoft, right? Honestly, I think Microsoft is starting to become one of the most resilient, probably most stable companies you can buy against even Apple, because it operates as a subscription-based company now, right? Like when they shifted to a subscription-based model, it offered more resilience. At a 28 PE, let's just kind of break it down a little bit here because revenue has been growing at double-digit paces very nicely. I mean, to get 10 to 20% revenue growth on the back of a company, again, generating $260 billion. I will point out that Amazon's revenue, and I really want to point this out because I think people think Amazon is the one generating this revenue. No, all this revenue, or for the most part, is actually just retailers buying and selling. If I buy a product on Amazon, they mark that down as revenue, but it really just mostly gets paid out, or all of it gets paid out for the most part, to the person that's actually utilizing Amazon. So this revenue isn't really money Amazon's generating, it's money the user is generating. Keep that in mind. There's a bit of a difference here, whereas this revenue is exactly what Microsoft is generating. So we can see, again, generating 12% revenue growth is astounding. We take a look at the earnings per share. Here we got a company that is growing earnings at double-digit paces. Not like insane growth, but still very healthy growth. And again, I'm not saying this is a cheap company, but it deserves to trade at a premium. If it drops more, nothing saying it's not a good buying opportunity, right? Now, the stock that I think is going to be the headliner, the AI future, can NVIDIA manage to sell insane amounts of chips still in the next 5 or 10 years? That's the question everyone has on their mind, where 50% of the revenue comes from Apple, basically Amazon, Meta, Google, like all the companies building cloud centers are relying on NVIDIA. But if they ever cut CapEx spending, NVIDIA is the company that's going to get hit the hardest. But trading at a 32 times multiple today, if you believe in this story, whoo, baby, you got to recognize that it's arguably the cheapest S&P top 10 company right now. I mean, the revenue growth is in a 50 to 100% clip, which is mind-boggling. If you take a look at the earnings per share right now, yeah, I mean, it's growing at 100%. Like, guys, like if it does this for the next year, you're looking at a pretty big discount in the company. This is why people are like, man, if you believe in NVIDIA's future, there's nothing wrong with buying it, I think, at these levels. It's incredible to think that NVIDIA is now down to a 30 PE. If we take a look at those price ratios, actually, this is the cheapest NVIDIA's traded since before 2020, which is mind-boggling. I mean, even in 2018, it wasn't trading at these levels. So again, I'm still a big skeptic over the very long term. I'm still a little hesitant because these companies are making their own chips now, and even if those chips are 50% less efficient, if they're making them at a 90% discount, they could just make two chips, to make up the performance difference. Maybe I'm an idiot the way I'm talking about this. I'm not sure, but we do know Meta, Amazon, all these companies are producing their own chips. So if they ever do capex cuts, this company could still massively get hit. So just be aware of the risk with a company like Nvidia. Now, my two favorite stocks, regardless about how you feel about ad spending, in this market environment, everyone's saying that these companies are seeing ad spending cut. In fact, Temu has been spending a lot of money on Meta, marketing, and they've cut back on it. So there's a lot of concern. There's a lot of price cuts by analysts, but I'm still very confident that regardless of this market environment, regardless of a recession, when we go back to a normal market, these are the platforms people are living on, and ad spend will always come back. In fact, it's one of the reasons that, Meta saw this massive 70% drop back in 2022 because people were so certain that ad spend would freeze up. But in fact, during this period, revenue was very stable, surprisingly. So I've become a little bit more confident in these platforms over time. There's a lot of fines going on or court cases and monopolistic behavior and all this other stuff. And it's led to just massive discounts. I mean, it's incredible to think Google's trading at an 18 times multiple today, Meta at a 20 times. They are the two cheapest S&P top 10 companies that have the same, or in Meta's situation, much better growth. In fact, Meta is probably the next fastest growing company to Nvidia in the S&P top 10. I think these companies are incredibly resilient. I think they're going to get through this no problem. I work for both these companies technically. I'm a YouTuber. I see the platforms. I use the platforms. I believe in these platforms. So this is why I keep buying them while they're on these discounts. So when I look at the S&P top 10 guys, it's really nice seeing Meta, Google 20% off. I'm going to run to these companies. Nvidia, if you believe in it. Tesla, I would still be avoiding. We talked about this on the live stream yesterday. You can go check some of that stuff out. But yeah, I would be avoiding maybe some of the recession-proof stocks that a lot of people have been flooding into lately, and go look to where you think the discounts are if you're into the individual stock game. If not, it's a great time to be buying the S&P 500, in my opinion, not as financial advice. But what about the Qs? The Qs are another interesting play here that I like to follow because the track record has been astounding. I mean, since I think the S&P 500, just from an equity standpoint, is only up like 200, 300% over the same period, where the Qs are up like 700%. This has been an incredible run since the 2008 financial crisis in the technology sector. I don't think this run has come to an end, but in this current state, I've always been a little bit hesitant because I don't believe in the long-term realities of all these companies. Again, Nvidia, I'm a little bit skeptical of. I'm a little bit more worried about the 10-year time horizon, and Apple's still very expensive. Some of the companies in here, considering at the end of the year, the Qs were trading at a 40 times multiple, which is a bit insane. But the reality is the Qs have actually dropped by 15%. And if you take a 15% haircut on that price to earnings multiple, it probably brings it closer down to a 34-ish multiple, which, to be honest, isn't that insane. It's not super crazy by any metric, and this ETF has always traded at a premium. I think the average over long periods of time has been around 29 or 30. So we're slowly reverting back to the mean, which again might mean we're heading back toward a healthier market environment. But again, in this market environment, I'd rather just buy the S&P, get the diversification, and then handpick the companies I personally believe in, because I don't believe in Tesla. Again, just my opinion. I don't think Nvidia is a bad company. I just don't understand it that well. Meta and Alphabet are great. I think Costco is quite an expensive company today. A lot of the companies that trade in here, I just think trade at premium. So it's like a 50-50 split. And I really don't want a 50-50 split of companies that I think are overvalued. When my personal financial independence, my retire early journey, I'm looking 5 or 10 years out. So I want to look at companies I think can do really well in the next 5 or 10 years, not companies where I feel like I'm speculating on that next 5 or 10 years, especially with companies like Tesla. So the only way we're going to get through this downtrend in this tariff war is we need two things realistically. We need deals to be made. We need clarity. If we get clarity, deals to be made, I think that would offer more certainty for Jerome Powell to cut interest rates. I don't think he's going to be pressured by Trump. It's not his job to be pressured by politicians. That would definitely help the market a lot on the back of interest rate cuts, but we also need companies to give better guidance, because right now I think we're going to get some uncertain guidance from some companies that deal with international trade. We've already seen Tesla, we talked about the auto industry starting to get hit pretty heavily. Ford's not sending anything to China. Tesla's pushing back their cheaper EV, their Model Y out till 2026, where we were supposed to get it this year. So it'll be neat to see what companies are the outliers. And I think those companies are largely going to be companies like Google and Meta. They might get those advertising hits, but I don't think they have to deal with international trade as much. Amazon will definitely be an interesting one to watch. Same with Apple. Microsoft, I think, might be a bit more resilient, but this will be truly an educational period. And it's crazy that if you've only been in the market for like the last 5 years, you have experienced 3 major drops. I mean, you got to think since 2009, we're looking at the S&P TSX. Let's look at the S&P 500. Look at these drops. I mean, it's incredible to think that, basically from 2009 onward, the market was so stable. And then since 2020, you've experienced 1, 2, 3 major dips. So if you've been in the market during this period, the education you're getting is so far beyond anything that you've gotten since 2008. I mean, think about it. There was the dot-com bubble, and then another decade, you had 2008. There was a really several year spans before you got these massive correctional periods. And here we are getting really large correctional periods. I mean, think, there's been 3 major corrections of, I think the pandemic was over 20%. Wasn't the pandemic more than 20? Let's just take a look here. Yeah, I mean, it was 30%. The 2022 correction was another 25 to 30%. So I really feel like most of the corrections that we've experienced, these 7, a lot of them have only, like 2 of them at least have only happened in the last 5 years. So you've been in a very rare period in market history. You know how incredible that is to say you're living through like this really unique period and you're getting these discounts in the market. So again, these are rare moments that you can capitalize on today. And you need to recognize that for what it is and realize 5 to 10 years from now, we might go back to a more nominal market. But time will tell. Past performance isn't future return, but I'd love to know what you think in that comment section below.